Tom Lee, as I said, is with me now as we turn back to the markets. He is a CNBC contributor, of course, Fundstrat Global Advisors. So it's good to see you.
Great to see you, Scott.
It's been a turbulent week.
It has.
Is it portend something that's going to come forward here for us?
Well, part of it is, of course, as you know, we're in earnings season and markets tend to be volatile around earnings. I'd say that some of the high-profile declines, like Intel, look bad over a one-day period, but Intel was $17 a year ago. So to me, it doesn't surprise me that you could see some of those stocks have done really well get punished a little bit on earnings.
I mean, this is a hard one to say it's representative of anything. I mean, you know, the company's obviously been challenged. They have the government backstop in there, and the stock was up a ton going into the print. As we turn, speaking of the print, the prints that matter next week, the mega caps, which you still love, but not quite as much?
I mean, we still like the Mag 7 and the mega caps because they're great earnings stories and they have a lot of visibility. But as you know, our top picks this year in terms of sector is energy and basic materials. But as far as earnings stories go, I think next week's critical because you got most of the Mag 7 reporting.
Tom, you're crushing that so far with that call. Energy and materials are the two top sectors.
Yeah.
Why were you leaning that direction as the year began?
You know, we were betting a bit of mean reversion taking place in 2026. One of the things we identified in our 2026 outlook in early December was that energy and materials underperformed over the last 5 years at a level that in the last 50 years have marked turning points higher. So we were betting that so much of the bad news was baked in that they could have okay fundamental years, but the stocks could do really well.
I feel like you were on the right path as it pertains to small caps and the Russell just a little early. Maybe.
Yeah.
I mean, remember, let's remind people, last year you told me up here that we were going to have a 50% gain in the Russell.
Yeah.
Now, obviously, we didn't have that, but the Russell is almost outperforming everything else over the past year. And in 1 month, it's up 5%.
Yeah.
That going to continue?
Yeah. One of the things we talked about a lot about last year was that when small caps turn, it tends to be a multi-year. In fact, it could be up to a 12-year period. So the last turning point for small caps, and on a relative price to sales last year or price to book, they were at the exact same point they were in 2001. That was a launch point for 12 years of relative outperformance. So I think small caps benefit from a Fed turning dovish, possible M&A wave coming, an ISM turning back above 50, and then catching up to where EM, because EM did really well last year, and small caps usually track that. It didn't.
Fed turning dovish, you know, we have a meeting next week, in case you didn't know, and not expected to do anything. So maybe not as dovish as people thought several months ago. And by the way, as we look at prediction markets, as we think about who might be the next Fed chair, BlackRock's Rick Rieder is now the leading contender in prediction markets. There's Kalshi. We, of course, have a partnership with them. 52% leaning towards Rick Rieder. We shall see. Do you care how much you think about who the next might be?
I mean, it's important because it reflects the market. Market needs to respect who the new Fed chair is. Rick Rieder is somebody that markets really do respect. So, as you know, the Fed has to communicate not only with the White House, but also with the bond market. And I think Rick Rieder's experience in the markets world makes him very credible.
But you're not expecting anything next week, right?
I'm not, but I'm also expecting the Fed to reiterate that they are focused on no longer fighting inflation, but looking at the job market. That's a Fed put on the economy. To me, that's a dovish tilt. And as long as they're not fighting inflation, to me, that's a dovish Fed.
And that's why you think the equal weight S&P is up 4% so far this year compared to the S&P, which is up 1%, and the NASDAQ, which is only up 1.5%?
Yeah, I think so, because as you know, not only is the Fed no longer is trying to establish inflation credibility, which is hawkish, QT has ended, which to me is the same as a version of QE starting. So we are facing a dovish Fed. Even if there aren't cuts, it's still a Fed that wants the economy to do well.
I'm not sure everybody sees every appearance that you have, and people generally think you skew bullish, which you obviously do. That said, you're still looking for what you've said could be a bear market in the middle of the year. Do you want to explain one more time why, even in the midst of this bullishness we hear from you, you still think stocks could have a bit of a rocky road at some point?
Yeah, I think 2026 has the same contours as last year. So in 2026, I think there's a good fundamental earnings story, earnings growth accelerating. But we have two transitions to deal with. One is the Fed, a new Fed. The market always tests a new Fed. So from confirmation, let's say that starts in March, a new Fed happens, and then the market tests him. That's one source of a drawdown. The second is, of course, policy. The White House is much more deliberate this year in picking winners and losers, and there's some uncertainty around the tariffs. Last year, that was enough to drive a 20% decline in the S&P. So I think the combination of policy uncertainty along with Fed could create a drawdown that feels like a bear market, but that's from higher levels as well.